if you had the worst timing in the history of the market, you were literally that one guy who dumped his entire portfolio into the market on October 1st of 2007. A year later, you were down 50%. All right. But guess what? 10 years later, you're still up almost 100%. And if you would have bought even on the way down, you're up 200%. Stop thinking about this on a day-to-day basis and think about this month to month, year to year, decade to decade. Okay.
Bear gang till I die, ho. Swooped up the homies and we about to start a sideshow.
Do you think there's an underlying crash waiting to happen? It's very possible, but everyone thinks that we're going to have a 1929 Great Depression, okay? I mean, I just want you guys to look at the chart, okay, of SPY. All right, it's a big difference between where we were 2001, 2008, and 2019, okay? You can only keep in... Here's the problem, okay? Here's the problem right here. Here's the problem. Here's the biggest problem, in my opinion, okay? All right? Here's the biggest problem we're having right now, is that the Fed has interest rates at zero, meaning, we already talked about this yesterday, that banks are getting money from the Fed at 0% and loaning it out at a very minimal rate, 1% to 2%, okay? So this is what they're doing. They're keeping interest rates at zero so that there's a lot of money and they're giving it out very cheap to keep people buying and spending money, right? So now I can buy my house and I can buy my car and I can buy my, pay things with my credit card. Yeah, that's all great. That's what the Fed's doing. They're keeping interest rates at zero so that borrowing is cheap. Everyone has money and they can stimulate the economy and keep the economy going and floating the economy until the economy returns. So we saw a dip and then we saw this, right? But the problem is you can't keep rates at 0% forever. Because if you keep it 0% forever, then inflation skyrockets. And if inflation skyrockets, okay, there's a very fine line. There's a very fine line, guys, between keeping inflation and spending, okay? You need people to spend money to keep the economy going, but you can't have hyperinflation, because if you start getting inflation, then you have to raise rates. And if you raise rates, spending stops. But if you have to raise rates to stop inflation before everyone gets their job back, then you're in double fuckery. You see what I mean? Now, inflation has gone up, and you have to raise rates to stop hyperinflation, but when you raise rates, you stop the loaning and the cheap money, which stops spending, which then has the reverse effect. It's a very, very fine line, and we are getting to a point right now where we're in a make-or-break situation. And that is why the Federal Reserve came out and said, hey, guys, we're going to focus on unemployment more than inflation right now. We're going to let inflation stay real low, okay? And we're going to focus on getting people employed, because if they're employed in the long term, they're making money and spending money, and the government's not loaning the money out, meaning there's no debt. We just found out that next year, debt is going to overtake GDP in America. So I'm not saying that today is a rug pull, okay? I've never said that. I am a buy the dip until the cliff kind of guy. All right. But what I'm saying is that rates can't stay at zero forever. Once we get out of a recession, I mean, in 2008, if you look at the Fed rate hike, okay, in the 1970s, 1980s, okay, we saw rates as high as 17%. Okay, came back down during the 1980 recession, 1987 recession, right? Then we saw rates go back up, and then we saw the 2001 bubble, and then they dropped rates to zero again. And then the rates went back up, and then we saw 2008 happen, okay? And then it went down, okay? But it's been doing this the whole time. Okay? What does that signify? That means that we're getting to a point where they can't even raise rates for too long before we hit a recession, or we hit a reasoning for them to have to drop rates to zero again. You don't want to see this happen. Aren't we just transferring wealth? Of course. I told you guys this back in March, April, and May. We would see the greatest transfer of wealth in human history this year. It happened in 3.5 months. We saw 5 guys, basically, become worth $100 billion in the middle of the greatest global pandemic we've seen in 100 years. How do you know when the cliff is? You don't. I already told you guys what this economy, what this market is right now, okay? The market is a bunch of people getting greedy, okay? The market, as a metaphor, is you trying to go from New York City to Los Angeles, okay, on a train. Okay? Now, you could walk there, but it's going to take too damn long. Okay? But you want to take a train. Well, guess what? You're on that train. Okay? You are on that train. Okay? But guess what? That train is speeding up. And it's speeding up really fast. And you're like, holy shit, I'm going to get there real quick. This is awesome. But then you find out there's no brakes. So now you have a decision to make. Okay? Okay, because we know that this thing is going to cross several bridges. And one of those bridges, you don't know which one, is out. Well, if you jump off now, yeah, you got a little ways, but you got a long, slow walk there. So you want to stay on this train, and you want to get as fast and as quick. But the problem is do you get off in time, or do you go down? Everyone is going to jump off too early or stay on too late. You're never going to time it right. Unless you are the driver of this train, who is the Fed and the institutions and the banks who can see exactly, they're going to hop off right here. They're the only ones who are going to time it right. What do you do if the cliff happens? You have two options. You see 2 days or 3 days with 2% loss in a row and you're down at 6%. Fuck it, I liquidate. Or you do, and exactly what I've been doing. So what have I been doing? I told you guys. In all seriousness, this is what I have been doing for the last month. Okay, and I told you guys when I started doing it. Yo, SA Silent, come with a T1, you rock, dude. Thank you. All right, so this is what I've been doing for the last, is this permanent? No. This is what I've been doing for the last month and a half. So normally, if this is my portfolio, okay, every month I put in money, right? I put in money and I allocate it. Usually I take, 75% of it and I buy my long-term holds. Okay, and then 25% I look for dip opportunities on what I think are projected growth stocks. That's great, okay? And I normally, every month, I put in money, okay? Regardless of if the market is up that month or down. It doesn't matter because if you dollar cost average, eventually as the market goes up, you have a lower cost and you make money. That's what you normally do, okay? But what I have been doing the last month is instead of taking that money and adding it to my portfolio, okay, I've been taking my swing trades and my wins and just allocating assets and moving money around. But the money that I would normally be putting in every month or every week or whatever, I'm just keeping on the sidelines. Yo, Jodak, my man. So I'm just keeping that money on the sideline. I'm not withdrawing any money. I'm keeping that money on the sideline. And I'm going to keep money on the sideline. I'm going to keep money on the sideline. So I'm not taking any money out, but I'm not adding any money. And the reason I'm keeping this money on the side, okay, the reason I'm keeping this money on the side is that if we do hit a cliff, okay, and my average cost is here, and we are here, okay? If we hit a cliff, and then we start, doing this again, then I'm gonna take all this money and dump it in. So then my average cost is even lower, so that way when we return, I make even more. Now, I don't want to take this money out because what if we never crash? Then I miss out on all this profit. But I don't want to add anything because what if we hit the cliff? Then I lose more. So it's about dollar cost averaging. But because of the volatility right now and the scariness and the fear in the market, I'm just not adding any more money in my portfolio. I'm keeping it in cash right now for potentially the election. If we see a drop between now and the election or right after the election, I can throw this cash at cheaper stocks and ride that bad boy back up and be set for a longer time. How do we know when we hit a cliff? When you lose 10% in a week, you're generally in the midst of a cliff. But remember, you guys got to think about this. Time in the market beats timing the market. Yeah, have a small portion of your portfolio, up to 10% of it that you swing trade, you play with, you have fun with. But most of it, you just dollar cost average. If we're going up, you buy. If we're going down, you buy. And at the end of the day, in the last 20 years, okay, I've already showed you guys this screen a million times, okay? All right? If you had the worst time in the history if you had the worst timing in the history of the market, you were literally that one guy who dumped his entire portfolio into the market on October 1st of 2007. Okay? A year later, you were down 50%. All right? But guess what? 10 years later, you're still up almost 100%. And if you would have bought even on the way down, you're up 200%. Stop thinking about this on a day-to-day basis and think about this month to month, year to year, decade to decade, okay? Every single one of you, okay, can think about a year ago today. I want you to think about September of 2019. How quick did that go by? How quick did that go by? Now think about that a year from now, okay? It goes by so quickly. So stop thinking a year from now is so far away. This is not a short-term game. Buy the dips. Some of y'all gonna get this on discount today. Manage stop losses. Okay, so generally speaking, stop loss and long-term investing should never be in the same sentence. God, I look homeless. I really need to shave my beard. Stop loss and long-term investment should never be in the same sentence, okay? So I'll explain it because the last two cliffs I got stop lossed out of and it saved me a ton of money. But I'll talk about it this way. All right, so let's look at it this way, right? All right, what happened with me? I'll break down 2018 and 2020. So, market, okay? Market funds, all right? Generally speaking, 2018, we saw a run, okay? End of 2018, we saw a dip, all right? I had a stop loss of about 3.5%, and that means a daily trailing stop loss. So if we were to ever drop 3.5% in a single day, as soon as it hit that point, it would liquidate everything, okay? I got liquidated out. Okay, I got liquidated out 3.5% because it happened on the second day of the crash. Okay, 2019, 2020. Okay, you guys remember February 24th? You were here on stream the day I got liquidated. Okay, now, what did that mean? I got liquidated, all right? I got knocked out of the market. So I got all these gains and got out with a small, decrease in the gains and then bought back in on January 1st, 2019. Okay, did I miss some of the run up? Yeah, I was not going to time it perfectly. Got that entire run. I got stopped out here, okay, and didn't get in this time. Instead of March 20th, I waited until May to re-enter the market. So I missed a lot of gains on the way up, but because I didn't take any loss on the way down, it was just double dipping. Now, that sounds good in practice. It sounds good in practice. If you are not a active investor and you don't know what you're doing, the reason that this is scary is because what happens if 2 months ago, okay? What happens if you have a long-term hold and you have a 3.5% stop loss, and this day we lost 6%, and you got stopped out right here? $20% in a month and a half. The market average is 7%. You missed out on 3 years worth of gains in 1.5 months because you had a stop loss that got knocked out and you didn't know when to get back in. That is the concern. That is the concern, okay, and of missing out. Now, you might be asking yourself, well, Stocky, if you get out, when do you know when to get back in? Well, you don't. You have to make that decision. I have a personal belief that if there is a day where my stop loss, whether it is 2.5% or 4% or whatever it is, gets triggered, I will not re-enter the market until I see at least 2 days where we close higher than we open on good volume. Then I will leg back into the market, okay? But because I'm an active trader, if I see this during the day and I get triggered here, I'll just start re-entering on at the same day because it might have just been, it could have been a flash crash, it could have been anything. But generally speaking, regardless of we are green and red, I don't know. I will wait 2 consecutive days, 2 days back to back of a gap up before I re-enter the market, okay? Now, does that mean that I might miss out on some potential profits? Yes, but it has been my plan in the past, and that is what I have done, and that is what I will continue to do, okay? A trend is a trend until it's no longer a trend. It works for me. It works until it doesn't work. That's how I re-enter, okay? And sometimes I take longer. Like in May, I didn't jump back into the market until May, even though there was several of these days in a row, because I was concerned. I was like, wait, this is not making sense. This economy is fucked. There's no way this market's going to keep going up. But then Jay Powell took the printer, okay, and went, brrr. All right?
It's always.
Exactly. Long-term gang will win. Listen, You keep your money on the sidelines, you buy the dips. Yeah, we're down. We're down big today, okay? We're down big today. It's not the end of the world. We saw a 6% day. Can you ask him to turn the printer back on? Listen, I don't know what tomorrow is going to bring, but if this is like it was a month and a half ago, you're going to be getting shit on discount today. It's up to you, okay? It is not, one red day does not mean this is the rug pull, okay? Unless this is the beginning of the rug pull or this is the beginning of the crash. It is not there right now. It is a down day. Imagine making 35% in the market in 2 months and it dropping 2% in a day. Doggy, I'll never financially recover. You're still up 28% when everybody else out there who doesn't know anything about investing is sitting on their cash and they're not making anything. Now, we have a lot of things that we looked at this morning as upside plays if the market goes supportive, but the market is not supportive. We've dipped under 340, okay? This is a very important line right here, this 340 line. We really got to pay attention to this. If we don't hold this, we could see a continued sell-off here, all right? Even the things that we liked and that popped pre-market went down, okay? So what happens is that when we look at these plays in the morning, like in the morning call, we say, hey, listen, if the market goes supportive, this is where we expect money to flow into. But if the market isn't supportive, everyone's selling. There's a lot of institutional money come out. I'm not going to lie to you guys. I'm concerned, okay? I'm concerned. I know I'm the level-headed guy who tells you guys, listen, these are dips. We keep going. We long-term invest. We don't liquidate. We buy the dips. Whether the dip is 5% or 50%, we buy the dips. We lower our average cost. And then when the market shoots back up, we make a shitload of money, okay? I'm a little concerned. All right? And that's because institutional size money, large amounts of money are liquidating. Now, when you look at the market liquidating like this, okay, well, we held 340 there. That's good. Okay, when you look at the market like this, you want to look at other things too. You want to look at commodities, right? You want to take a look at gold, right? For example, is money moving from the market and into gold? Not really. There's some, but not really. Okay, so let's take a look at Bitcoin. Are people moving it out and moving it into cryptocurrency? No. So then you have to sit back and say, last chance, are they moving it into bonds? Bonds are shit right now, but let's just say, are they moving it into bonds? No. So what does that mean? Let me bust out the whiteboard. Generally, when markets dip and you see large amounts of institutional money, it really depends. Okay, this is not a end all be all. Because remember, guys, you're zoomed into the 1 day, 2 day. You're not zoomed out. However, what we will say is if we continue to see, okay, equities, which is the stock market, gold is a hedge, crypto for whales and retail traders, and bonds for management firms, okay? So, generally, if we see equities go down and these go up, like gold, even if gold's sideways, crypto's sideways, and bonds are up, okay? Well, then we can say, all right, the money is transferring from one to the other, okay? Or at least liquidation and asset protection here. Or if, you see another one, okay? That tells you that money's moving around, okay? The concern becomes, now what we recently saw was actually a full-on bearish sentiment. Basically greed, okay? People were trying to squeeze out as much profit as possible. So, then comes the question. If equities, which are stocks, are going down, and gold is going down, crypto's going down, and bonds are going down, where's the money going? There's two other options. And if institutional money is selling it, a lot of times they're taking 0% interest rate loans from the Fed. Okay? They're buying, running that market up, selling, giving it back, and then keeping the profits. Now, We don't know if that's happening. This is only day 1.1. Okay? So we don't know what's happening yet. You're looking at a microcosm. All right? But we all know in this chat that this run is not sustainable. So is today the beginning of the next pullback? We don't know.
Welcome, Relax to the Bear Gang. Hello.
I will make my decision today, for me personally, not for you, for me. If we hit negative 3% today, okay, I'm going to start moving out of some positions. But remember, for those of you guys that are new to this, understand what a wash sale is. First in, first out, last in, last out, first in, last out, okay? What does that mean? Do you want me to explain that to you guys so you guys can understand where we're at? First thing we're going to talk about is, for the U.S., we're going to talk about capital gains tax, right? So, generally, if you hold something for more than 1 year, you pay a significantly less amount of tax, okay? So, if I'm going to liquidate my part of my portfolio, I'm going to start with the first in, first out. Because I want to sell part of my portfolio to protect myself in case of further leg down, but I don't want to get hit with more taxes. So I'm going to start moving out the stuff I held over a year. So that way my taxes that I pay on the realized gains, and realized gains just means profit made when sold. So if I bought $10,000 worth of something and a year later I have $14,000 worth of something, I have to pay taxes on $4,000 in gains. Okay? But I'm going to pay less if it's something I've held over a year than if I short it on the short term. Okay? All right? So generally what I will do is I will look at something I have and say, okay, I'm going to sell whatever I had the longest. Okay? Or if it's a specific share, whichever shares I bought first. So if your broker, however it sets it up, is, let's say I've been buying Apple since 2018, and I've been buying it all the way up until this year, I'm going to first shares in, first shares out. So that way I don't get hit with that extra tax. That's me personally. All right, boys. Today might be the day Stocky actually sells some shit. Okay. Oh, God. I'm not going to tell anyone here to buy or sell. This is up to you.
Anonymous donated $3. Thanks for the advice, Stonky. I just put all my money SPY 9/11 $250 puts. Remember this, Dono, when they make the big short too in a few years about me.
Okay, buddy. All right, we have broken below the level that I wanted to see us protect. Okay, we have broken below. Why sell here? I'm not selling. I'm not liquidating my portfolio. I am possibly looking to move out of some positions that are high risk right now. I don't freak out, okay? I don't freak out. But then again, in February 24th, I liquidated and missed out on 25% losses. Personally, for me, because I've been not adding any capital to my portfolio and leaving cash on the side, I don't really want to liquidate. I just want to buy more into the dips. But we got to find out where that dip goes down to.